Hello, everybody. Charles Howarth here. Today, I'm going to do a short video and just tell you about one of the most important starting points for anybody who wants to invest and grow their wealth to understand. And anytime I get asked to talk about investing and explain where to put your money and how to grow your wealth, I always begin the discussion with explaining the effect of compound interest. So first thing to do is go and open your web browser and open up a compound interest calculator. There's a recommended one here that I like a lot at nerdwallet.com. So just type in compound interest calculator or go to the link that's in the description below and pull this up. And for anybody who's wanting to think about investing, what you do, go here and then just have a play around with this calculator. Let's play with some numbers together. What's really interesting about compound interest is that effectively it's the effect of earning interest and then getting interest on that interest over time. And it may not seem like a very profound impact, but it has a massive effect, especially over long periods of time. And it actually works on an exponential curve. So you start to see exponential type returns on your investment, and relatively small investments compounded over long periods of time can have really exceptional outcomes. And so in particular, if you're a young person and you want to start thinking about this, come in here, play with a calculator and see what it can really do for you. And it's almost a magical effect. So first example, we just run through here, $100 deposit, 100 euros, 100 pounds, all the same. I put in a 2-year time period, which is very, very short, so we shouldn't see a big impact. Estimated rate of return. Now, this can vary depending what you're investing in. If you're putting your money in a bank account, you can get very small rates. And what I'll do is I'll play with rates of return in a moment. But I want to show you the impact. I chose 8% because that's roughly the return that you would get if you invested in a global or like an S&P stock index tracker, or a very common funds and ETFs return these amounts. And then what I've put here is $100 a month contribution. So $100 starting deposit, $100 monthly contribution. And then you can see over 2 years, your investment goes from your initial 100, you keep adding 100 year on year, and you'll get to $2,700 after 2 years. Okay, not super exciting. But let's see what happens now with exactly that same profile if we start to extend it out. So let's go to 5 years, what happens? So 5 years, $100 a month, and now you start to get up to $7,500. So, okay, more interesting now. 10 years, more than doubles. It goes to $18,000. So that's starting to become a big number now. That's enough, to buy a car or something important, a deposit for a first house potentially. What happens if we compound that now for 20 years? Well, now you can see the interest line here. If you look at this chart, it's very interesting. So the blue line is the principal. That's the amount that you're contributing. And what you can see is that the principal just goes up linearly because you're adding $100 a month. But what happens here is you can see this green line is hockey sticking upwards, and that's the exponential growth that you get on the interest. Wow. Okay. So over 20 years. So imagine right now you're 20 years old, or you have a family member that's 20 years old. By the time they're 40, they can see this type of return for what's a relatively modest monthly savings. And then if we put this out even further, let's go out to 40 years. So if you're 20 years old today, $100 a month, put it into an S&P ETF or some kind of tracker that's getting about 8% rate of return. But by the time you're 60 and you're ready to retire, now all of a sudden you'd be sitting on $350,000. And you can see that in this example, the thing which is generating all of the money is really coming from this interest and the compounded interest. If you look at the principal line, it's relatively flat, relatively low. So in that 40-year period, you would have contributed over 40 years, $48,000, but the interest will have earned $300,000 of that interest. So this is your money working for you. And this is without doing very much at all, just by investing. Now, what I want to show you is the impact on this rate of return. So we looked at a very long period. Let me curtail that back a bit. People sometimes can't get their head around 40-year time frames. So let's go 30 years. So start working at 20. By the time you're 50, so you're not even at the end of your career, not retirement age, you're 150,000 with this very modest amount of savings. Now, if you, instead of putting it into a kind of a stock market tracker, which is earning you something on the range of 7, 8, 9, 10% per annum, and instead you invested it in a very safe savings account, or you leave the money in your bank account, what happens? Well, what happens is you'll be earning something maybe on the order of, on average, I think interest rates have been around 2% historically. So over that same period of time, instead of earning $150,000, you would only earn $49,000. This is a huge delta. And you can see the portion of the principal which you put in versus the interest. So getting the percentage return up higher is extremely, extremely important, and has this massive compounding interest rate. If you're a very good, trader, and you got into this side of things and you could be earning, say, 15% a year, then it's game changing, right? And so these are huge, huge numbers. The variance at every 1% that you change on the rate of return has a huge impact. And so in some future videos, I'm going to take you through, when you're looking at investments, how to make sure that you pick investments that are going to get you stable, good rates of return, which are above inflation, and with low fees. Because you can see here that if you earn, let's say, a 10% interest rate, but the ETF or the fund or the broker or the third-party advisor was charging you 2% interest every year, instead of taking home $228,000, you would take home $150,000. So those fees, when you're investing, are very important, and they also impact the exponentiality here. So two things: get the percentage return up. Now it's risk weighted, but there are still some assets like S&P 500, like global stock market trackers, that can give you those type of returns on a pretty regular basis, and get those fees down. And that's how you can start earning significant amounts of money. The other thing that I would say on this is looking over a 30-year period. And again, if this is your start of your investing journey, it's very likely that, the idea of putting $100 a month away is probably quite a lot. That can be a lot of money for some people. What I would say, though, is that get started with whatever you can put in, because it's compounding. And what tends to happen is that as you get older, as you start to, work through your career, actually the amount of money you'll have will be higher, and then you can put more and more and more. And then the more that you can contribute as a percentage of your take-home salary, the better it is. So get started. And I'm going to leave you with a little saying that's extremely true. Investing is about time in the market, not timing the market. The longer you're in the market, the more this magical effect of compounding interest will help you to make money and hopefully change your life. Thanks a lot. If you're interested in more content like this, hit subscribe, share my videos, it would help me out, and leave some comments if you have any other topics you want me to cover. Thanks, and see you all soon.